Hi, Jeff McMullen, Cross Country Mortgage. Wanted to talk to you today about private mortgage insurance and what it is. First and foremost, private mortgage insurance is an insurance for the banks, not for you. And what that means is, long time ago, like before I started doing loans, the banks determined that loans with less than 20% down were riskier, and that initially they didn't want to do those loans. And so what they did instead was they said, we'll do the loans, but we're going to need some sort of insurance. And so insurance companies came up with PMI, or private mortgage insurance. And what that is it's an insurance that is paid by the client, by you, the buyer, to offset the risk to the bank. And so you pay for this insurance. There's a few different ways to do it, but there's basically three main types. There is what's called monthly PMI. Monthly PMI is literally that. You pay a monthly fee of mortgage insurance until your loan gets to over 20% of the original purchase price. There's also what's called single premium. What single premium is you just pay a big fee up front, and then you won't have mortgage insurance. In some cases it can be 1 to 2 to 3% of the loan amount. But you would pay that up front, and then you wouldn't have the monthly fee. So some people opt to do that to keep their payments lower. And then the third is a hybrid, or what we call split MI, which is you pay a bit of a premium up front, and you also pay less month to month because you're paying that upfront premium. So that is ultimately the way that the mortgage insurance is paid. The next question we get about mortgage insurance all the time is, how do I get rid of it? Like, I have this mortgage insurance, when does it go away? And just to be clear and to reiterate, we're talking about conventional loans and conventional mortgage insurance. FHA is a completely different conversation about mortgage insurance. However, on a conventional loan, mortgage insurance can be removed a couple of ways. One is you can just pay the mortgage down. So if you start out and you have mortgage insurance, and then you pay your loan down to 80% of the original purchase price, or the original value of the appraisal, then the mortgage insurance will get taken off by the servicer. If you want to get an appraisal that says, hey, my house is worth more, you have to prove that there's been significant upgrades to the house. That's if you do it in less than 2 years. If you wait 2 years and then you get a new appraisal because the value is more, and the appraisal comes in and it shows that the loan is 80% of the house price, then they will actually remove the mortgage insurance for you. So that's basically the three ways to get rid of mortgage insurance. The other questions I get are, how much is mortgage insurance? And the answer to that is, it depends. So mortgage insurance is based on a few criteria. The most important are down payment and credit score. So meaning, if you put 5% down, your mortgage insurance will be higher than if you put 10% down, and it will be even lower if you put 15% down. So the idea is, the more money you put down, the lower your mortgage insurance. And also your credit score matters in this case, right? So the higher the credit score, the lower the mortgage insurance will be. So that's usually what we tell people. There are other factors that get looked at. We look at, are there multiple people on the loan? Are there non-occupant co-borrowers, meaning is someone co-signing for this loan? We look at, are the clients self-employed, because that's viewed as a little bit riskier. Are they first-time home buyers? And so there's basically a criteria that we go through. What we find, though, is that and I guess the good news about mortgage insurance is that there are multiple mortgage insurance companies. We look at 6 every day. And so when we pull your credit and we look at your information, we definitely can shop the mortgage insurance. And what we found is that because we have so many different options now, we also are seeing that the rates have become much more competitive. What I would say is, don't be afraid of mortgage insurance. Get the numbers and get the quotes, and just see how much those monthly payments are going to be. See if it makes sense, and see if it's a reason to move forward. If you have any questions, feel free to reach out to me. As always, my cell phone is 831-210-4034. And hopefully you enjoyed this, and you can like this post.